Okay, ladies and gentlemen, welcome. This is again our subject 4ST441, Statistical Methods and Capital Markets. Today we have here our seminar number 10, so I hope that you are ready and we can start. So today we will talk about our project, yes, about your duty, your semestral work. So our project, paper and presentation. Maybe you remember something from our first seminar. Now you know everything to finish your project. Yes, on our previous 9 seminars, as we talked about various methods and steps, yes, and other issues, and now you have the knowledge, yes, for the preparation of your paper and after your own presentation. So let's repeat the requirements and the procedure. Yes, the possible grades from our subject are 1, 2, 3. Or 4, 1 the best possible grade, yes, 2, 3, and 4 is failed, yes. So you will be evaluated based on your paper and presentation, paper written in English language, and this will have the weight as 70% of the grade, and presentation also in English with weight 30% of the total grade, of the total evaluation. Total number of points which you can reach. Yes, it's based on our syllabus of this course. Grade 1 from 90 to 100 points. From 75 to 89 is grade 2, and from 60 to 74 is grade 3. I hope that there will be no case with grade 4. I hope that you will be successful, but it depends on you. Yes. Okay. So about paper. Something about paper. The deadline for the paper is 12th seminar, and because we have our seminar set on a particular day in the week, yes, the deadline will be on this day, yes, in midnight. So in SIS, in your school information system, I will open the depository. Yes, I will open the depository with the deadline. So this will be set in INSYS, and your duty will be to upload here the paper. Yes, this paper part. The paper will follow the methods taught in the seminars and lectures. Yes, the structure of the paper will follow the topics of seminars and lectures. It will be an application of statistical methods to the analysis of time series of stocks and log returns. Yes, so we learn some procedures, as methods, etc., and you will use these knowledges as for the preparation of this paper. The choice of time series of stock prices is up to you. This is important. You have a lot of degrees of freedom. You can download some time series. You are able to evaluate this time series, and if you realize that this time series is not good for you, yes, not good for your analysis, you can just delete this time series and download another one. Yes, it depends on you. There is no strictly set time series which you must use. Yes, so it depends on you. Use real data for at least 1 year, about 365 observations. But you remember that in our examples, when I used, for example, Google, Boeing, etc., we have only, I don't know, 280 observations because of working days, yes? So 1 year contain 365 days, yes? But if we use only working days, which is obvious, you will have, for example, 280 observations, but this will be enough, yes? I agree with 1 year of working days, yes? Of the amount of working days. The paper in English should be about 10 to 20 A4 pages, of course with text, yes, with the sentences, paragraphs, formulas, tables, graphs, etc. Yes? Okay. Structure, yes? Title page. Yes, it will be necessary to have a title page, of course, because it's a paper with name, study branch, name of the time series of your set, time series, selected time series, the content, yes, elementary statistical analysis and characteristics of time series of stock and stock log returns. Yes? So the main two time series which will be demonstrated during all semester. Yes? We calculated almost everything on stock prices, for example, close prices, yes, and stock log returns, calculated log returns from the prices, yes. Autocorrelation test in time series of stock log returns, homoscedasticity test in time series of stock log returns, normality test in time series of stock log returns. We talked about this, yes. Arma model, diagnosis and forecasting, and volatility models, either GARD or ARC, yes. We talked about ARC, more about ARC, yes. So it will be enough to use ARC, yes. Of course, there's possibility to use GARD, but ARC will be sufficient for me, yes. So don't worry. That GARD is complicated, you have the possibility to use ARC. Okay, summary and some conclusion, and of course resources, for example, the citation of downloaded time series, or if you use something from the literature, it's necessary to use to write resources. Okay, so this was a paper which will be prepared in some text document, yes, and I prefer, it will be good to upload to the data depository in INSYS, yes, PDF file. Yes, it will be best for you and for me, because what you upload to INSYS, I will see. Yes, so you will write your paper in some text editor, yes, either Word, Microsoft Word, or Writer, or LaTeX, or other, yes, other text document, and you will export PDF file. This will be the best option for everybody. Yes. And now something about presentation, short and brief description of the results of your analysis. Yes. It will be necessary to prepare a presentation, for example, in PowerPoint. Yes. For example, in PowerPoint, if you don't have PowerPoint, if you have other presentation software, it's possible, yes, but you need the slides, yes. You will not present your paper, yes, you will present to the public slides, yes, and you will speak during your presentation. You will present your paper at the 13th seminar, yes, so the result of your work will be presented at the 13th seminar. You must be online in Microsoft Teams. This is very important. You had the possibility to study this subject anytime, yes, anytime you need, yes. It was not a duty, yes, to be online during the time of your seminars during all semester, but in 13 weeks this will be necessary, yes. So I know that you are abroad, yes, I know that you are shifted in time, yes, you have some lacks in time, yes, because of different countries, yes. But here in the Czech Republic we have some time, yes, and the timetable, and on the 13th seminar it will be necessary to be online because you will present your paper, your presentation, yes, to me and also to your colleagues, yes, to your schoolmates. So everybody hear you, yes, during this 13th seminar. So this is very important. If you are not able to be present on the 13th seminar, you will not present the presentation and you will lose the 30%, yes, of the total evaluation, yes. You know about this from the beginning because I already said this information to you on our first seminar, so this is very important, yes. So you must be online in Microsoft Teams at the 13th seminar. You must be able to share your presentation in PowerPoint or in other presentation software, yeah, so your slides, and you must be able to speak, so you need a microphone, yes? You need at least a microphone. It's not necessary to have a switched on camera because we will see slides, yes? You will share the slides and you will speak. Check your Microsoft Teams setting before the presentation, this is very important. There will be no time for technical issues, so be ready to present, yes? I strongly suggest you trying the presentation at home in advance in Microsoft Teams, so you can manage appointment, for example, with your schoolmate, yes, and you can try to share this presentation and speak to microphone, yes, to your schoolmate, yes, and speak about this, yes, and train this. Okay, the presentation of your topic should be in English and approximately 8 to 10 minutes long. Probably I will send to you some information email about the total number of papers which were saved to data depository and INSYS by students, as because I know that I have some number of students in INSYS registered to this course, yes, but I don't know the total number of students who are still alive, yes, who are still active, yes, because it's possible that somebody finished the study, yes, or stopped studying, yes, etc. So I don't know the total number of active students. So when I see the saved documents in INSYS, I will see that I have 7 active students, 10 active students, 15 active students, yes, I don't know. So I will divide our seminar to all active students, yes. Okay, pick up and present only the most important results of your work, yes? The most important results. For example, I suggest you presenting graphs and comment each of them with 2 or 3 sentences plus present conclusions, yes? You have to have written the paper before presentation. The deadline is 12th seminar. I already said this information. You may be asked to discuss the content of your paper with teacher if some parts of the paper or presentation are not exactly clear, or if any other issue arrives. So you must be ready, for example, for some question from me. Yes. Okay. And it will be good to show you something in EViews, some repetition, what we did during all semester, and what is necessary for you. On our seminars, we use, for example, these web pages, Yahoo Finance, and I downloaded for you, for this example, a time series of prices of Dow Jones Index. Yes, it's possible to find on internet a lot of information about the development of this index, and I downloaded probably 1 year of the development of this time series. So I have ready this downloaded series here in Excel, so we can open this and you can see that it's common structure. It's common structure where we have here open prices, high, low, close prices, adjusted close, etc. And so the classical development of prices in Excel format, and we will open this sheet in EViews or other software. Yes, I didn't say very important information. It's not necessary, yes, to use EViews for your analysis. You have free hands and you can use any other software, RStudio, StatGraphics and other. Yes, I showed to you everything in EViews because I am able to work in EViews. I have a license, yes, for EViews. But if you don't have EViews or if you don't like this software, you can use any other. Yes. Okay. So for illustration, I have here EViews. It's necessary to close this document, this sheet. Yes. It's not possible to open sheet in EViews if this sheet is already open. Yes. So I will click on File button, Open, File, Open, Foreign Data as Work File, and in Downloads. In Downloads, I have here as Dow Jones Index on the top. So I will open this and we will click on Finish. Yes, we'll click on Finish. And here we have a work file. Do you remember when I said that it's necessary to have at least 1 year of observation? Yeah? There was written 365, but 365 is number of days, and many of these prices, stocks, yes, on the market, yes, is available only in working days. So here, in the case of our Dow Jones Index, which is here used for the presentation, we have here 253 observations. Yes, so in year 2020, I downloaded for you I downloaded year 2020. Yes, we had 253 days. in this year, yes, where was possible to sell or buy, yes, with the development with these prices and indices, yes. Okay, so okay, we have here close prices with this mark. I will rename this. Yes, I will rename this. Rename and delete. I will delete this last part. Yes, it will be close, just close, and here also just close. Yes. Okay, we'll use close prices. Yes, close prices for our analysis. Okay, in our slides was written that we can use prices and logarithms. Yes, so we will start with prices and also we will add the logarithm. So please open close prices. We have here the development, yes, of prices, and we can check the chart. Yes, click on view, graph, and we'll use line and symbol. Okay. So this is the development, 1 year development of prices. Yes, we will calculate. We will move this chart here on the right side, and we will calculate logarithms. Yes, the shortcut will be, for example, logarit. Yes, so it will be necessary to write here a command. Yes, so we'll write here a series. We'll write series. For example, log space rit, yes, because we will use today, I will show to you only this time series, no other, yes, so we can use this log rit, and the calculation will be logarithm, yes, so we'll write log, we will open the parenthesis, and you remember that logarithms are calculated like logarithm from ratio, yes, ratio, and here we must write close divided by close prices in time t minus 1, yes, our very well-known formula, yes, of course, close divided by close in time t minus 1, this is in parenthesis, perfect, so we can click on enter, and logarithms we have here, yes, okay, so here we have logarithms, and it's possible to click on view, graph, and okay, line and symbol. Perfect, yes. You can see logarithms. You can see logarithms fluctuates, fluctuates around 0. Okay. I have here a document in Microsoft Word. Yes, you know that it's necessary to create some title page. Yes, I will not show you how to create title page. Yes, it's individual, it depends on you, but this is necessary. After, I'm expecting some introduction part where you'll speak about the development of this time series, about the selection of your time series, etc., and about the story. Yeah? So if you select Dow Jones Index, I selected Dow Jones Index. Yes, you will not use Dow Jones Index because this is a presentation for you. You will use anything other. Yes, anything other what was not presented during our semester. Yes, so there will be some introduction part, and of course it's possible to put the charts, yes, to this paper. You can see that many softwares, yes, can, for example, copy and paste. Yes, right button, copy, and paste to this document. Yes. Okay, you can see it's possible to work with this, yes, to change the size of this picture, etc. Yes, because I will also pay the attention for the graphical formatting. Yes, your paper will be nice. I will be happy. If your paper will be ugly, I I will not be happy. Yes, and it's necessary to have a nice paper and correct paper. Yes. Okay. So you can see that it's possible to copy the charts. We can return to e-views. Okay. What else we did when we evaluated this time series? We will check the distribution. Yes. For example, here you can click on View. We have here Descriptive Statistics and Tests, and then we have Histogram and Stats. Histogram and Stats. You can see distribution. Distribution of values. The most frequencies. Yes, the most frequencies are concentrated on the right side. We have here skewed distribution, yes, and we have here some descriptive statistics, and also this can be used for your description in your paper. So I can imagine that you will use, for example, this chart. It's not necessary to show now. Yes, we can use this chart as put it to your paper and comment the basic statistics, comment the mean, median, maximum, minimum, the variance, yes, skewness, because we talked about skewness, and this is not normal distribution. Yes, you can see. Okay, the same we can do for log returns. Yes, so we have here log returns. Okay, we can check View, Descriptive Statistics and Tests, Histogram and Stats, and this seems to be normal, but according to p-value here, you can see that it's not normal distribution because probably it's much more kurtosis. There is more kurtosis than is necessary for the normal distribution. Yes, the kurtosis wealth here is large. Yes, so again you can comment these basic statistics, etc. Okay, so we talked about this. Yes, and I expect that this can be a part of your paper. What else? For example, the correlation structure. Yes. We will start with prices, yes, and after log returns. So we can move log returns, and where we have prices, close prices here. So correlation structure, yes, possible correlation structure. This is very important for you, because you must select the time series, yes, for example from Yahoo Finance or other depository of time series, where you are able to identify some correlation structure. Yes, because in your paper it will be necessary to create a model, yes, and without the correlation structure, you are not able to create a model. Yeah? So I recommend to you download from Yahoo Finance more time series, more development of prices. Yes, and first think what to do to evaluate the correlation structure. Yes, please click on View. Correlogram, yes, and correlogram of level. It's necessary to check this correlogram of level. You can see that on level we have here some correlation structure, and also there is some partial correlation. Yes. And other very important thing is to find a correlation structure on differences. Because if you can find on prices, yes, the correlation structure on differences, you can expect that you will see the correlation structure also in the case of log returns. And for us, will be necessary to model log returns. Yes. So please move this chart to the right. Yes. It will be necessary to leave this chart to the right. And there we have log returns. Yes. Okay, so please check view correlogram and correlogram of level. Yes, perfect. This is the development of logarithms of ratio. Yes, and this time series fluctuates around 0. Yeah? So you can see that on level position there is correlation structure. Please check this chart with correlogram, view correlogram of first differences here. Yes, you can see we have here log returns and some correlation structure, and there we have prices in differences. So there is correlogram for calculated simple differences of close price divided by close price minus 1. Yes. So this is very important for you, and maybe I could say this information for you at the beginning. Yes, because it will be necessary to download a lot of time series, 3, 4, 8, 15, yes, I don't know how many, but you must find the time series where you will see this development. Yes. So, correlation structure, significant correlation structure in the case of log returns, and significant correlation structure in the case of close prices on the level position and close prices in differences. Yes. If you see this, something like this, where you can see zero hypothesis, there is no correlation, there is no autocorrelation, there is no dependence in the data set, where this hypothesis is rejected. Yes? So this is again very important part, and this must be a part of your paper. Yes? Again, you can copy these charts, and you can paste these charts to the Word, to the text document. Yes. Be careful. It's complicated, a little bit complicated, because this chart, yes, is in original a chart. Yes, we can train it, and you will see what you will see in Word. Yes, you can copy and paste to the Word, and you will see that this will be ugly. Yes. Okay. Yes. So it's complicated. You must use a picture. Yes. You must use a picture or a screenshot. Yes. For example, screenshot, and put the screenshot to the Microsoft Word. Yes. So I believe that you are able to work with this, yes, and paste it, because yes, you can see it's possible to work with this, etc. Yeah, this is just illustration. We will have enough time. This is fastly now. Yes. Okay, so minimize this. We are here back. Okay, so when we are able to identify the correlation structure and comment the correlation structure, we are able to identify the model. Yes, and we will model the prices, and we will model the log returns. Yes. So do you remember? The rules for Arma structure? The rules for Arma structure. There we have log returns. So we will create as the model Arma. For example, with one parameter phi and one parameter q, because you can see that there is, if we imagine that all values are, for example, on the right side, yes, I can see here the exponential decreasing of values of autocorrelation function, and also here the exponential decreasing of values of partial autocorrelation function. We can try to identify Arma model 1.1. Yes, Arma model 1.1. So we will click on quick button, estimate equation, and we will write here. So what will model? Logarithms. Yes. So please use log returns. And I will write here AR1, MA1. Yes, AR1, MA1. Okay, we'll use classical least squares method. And be careful at home, if you have the new version of EView software, don't forget to check options, yes, and select classical least squares, yes, classical least squares method. Okay, so please click on OK, and we will see this. Okay, MA in this situation is not statistically significant, so your duty will be to identify the correlation structure and find the appropriate model. Yes, this is good attempt. Yes, but not significant model, because at 5% significance level, this coefficient is not statistically significant. So I will omit this coefficient. We will recalculate the model and we will check the correlation structure. So please click on estimate, delete, zoom this, delete MA part, yes, okay. And there is only auto regression part. I will check view button, and I will check the residual diagnostics and correlogram. We must explain everything in the data set. Okay, maybe we will try to use auto-regressive model of the second order. Yes, I don't know the order of model, I don't know the parts which must be included. So please click on estimate button, zoom this, and we will add the autoregressive part of the second order autoregressive model for the second order. Okay, so AR2, okay. And you can see AR1, AR2, we have statistically significant, yes. So your steps, yes, can be also commented in your paper, yes. So I used this form of the model, it was not statistically significant, and I used another one. There is some result. We will check the correlogram. So please click on view button. There is a residual diagnostics, correlogram to statistics. Okay, and we will check what is written here. Okay, so at least on first three positions here, yes, which is calculated here, there is no significant correlation in the residual error component. Yes, residual error component. We need to have data which are not. We need to have a residual series. Yes, which is not autocorrelated, because everything must be explained by our model. Yes. Okay, so maybe this is enough. We will check the development of residual series. Please click on view, actual fitted residual, and actual fitted residual graph. Yes. Okay. Actual values, fitted values in the residual series. Can see there will be maybe there will be a problem with heteroskedasticity. Yes, problem with heteroskedasticity because you can see that there is a constant development in time, yes, of this residuals. But at the end, there is significant increasing of variance, increasing of variability. So this will be maybe a problem. Also, as this chart can be part of your paper, etc. So please, it's necessary to comment your steps. It's necessary to give me the proof that you did everything, you analyzed everything, you evaluate everything, yes, and you paid attention to everything, yes. So, because I think that there will be problem with heteroskedasticity, we'll check the diagnostic test. Please click on View. There we have a residual diagnostics, and then at the end we have heteroskedasticity tests. So select this. We will find the ARC test, autoregressive conditional heteroskedasticity, the artificial regression of residual series, and we know that zero hypothesis is there is no heteroskedasticity. Yes, homoskedasticity is the zero hypothesis, and this zero hypothesis mustn't be rejected. So we'll click on OK. Please do it. Please do it. And yes, there is a problem. Yes, there is a problem. It's homoskedastical. Zero hypothesis is rejected, so there is a heteroskedasticity, and this model probably will not be sufficient. Yeah, this model will not be sufficient. Okay, what else? We can click on View button, Residual Diagnostic. We can check histogram normality test, and the original time series of log returns was not normal. Residual series is also not normal, so there is also a problem. Okay, so we can return back on View estimation output. Yes, View estimation output, and we can summarize. Yes, we can summarize everything. So this is a potential model, yes? Potential model for your paper. Arma 2.0, yes? Arma 2.0, where we have significant coefficients, probably where is no present autocorrelation because Darwin-Watson stat is 2.05, yes? But there will be a problem with heteroskedasticity because of high volatility of the data, yes, and the problem with the distribution of residual series, with normal distribution. So there will be problem for calculation of forecasts and using normally distributed quantiles, yes. So this is one conclusion. We can use this model as at least for illustration. So we will name this model, and we will write here, for example, equation space log returns. Yes, equation log rit. Yes, so this will be the first attempt on the model of log returns, okay? And the same we can try for case of prices. So we can close this, and we have closed prices here, yes? And now, maybe I did not show this to you in the past, but we can return here on view button, correlogram of level, yes, correlogram of level, okay. This is the correlogram of level, and this seems to be like a random walk, yes. High values of coefficients of autocorrelation function, yes, and the first very important, very significant coefficient of partial autocorrelation function. Do you remember about augmented Dickey-Fuller test and about the testing of stationarity? Please return to the chart, to the development of this time series of closed braces. Yes, view graph. Okay. A few seconds ago, yes, I talked that this time series is probably something like Renault. Yes, at least. The autocorrelation and partial autocorrelation function seems like development of non-stationary time series, yes? But you remember that we talked about exact tests, yes? Augmented Dickey-Fuller test for testing of stationarity. We know, yes, it's practically every time, yes, that logarithms are stationary. Logarithms are stationary because its development oscillate around 0, yes? But this time series doesn't oscillate, yes? So it's also possible to include to your paper, yes, evaluation of the time series of prices, yes, about the development. Because probably we will see that this time series is non-stationary and modeling of this time series must be done in differences, yes? Okay, so please click on view button. Do you remember we have here unit root test, yes? Unit root, we will test level, so this development which you can see here, and we have 3 types of models. Model without intercept and without constant, known. Model with intercept and model with intercept and deterministic trend. So we will evaluate all 3 models. We will select the best one, yes, and we will say the decision. So please, we will select known. Okay, and I hope that you remember the zero hypothesis. Zero hypothesis, non-stationarity. Yes, non-stationarity. That is the result. Zero hypothesis time series as a unit root. It's a non-stationarity. P-value is above 5% significance level. That means that zero hypothesis is not rejected. And coefficient rho must be equal to 0. Yes? And what is here? That is minus 0.0004. But according to p-value, this coefficient is not statistically significant. So, on the basis of augmented Dickey-Fuller test, yes, model without constant and deterministic trend, this time series seems to be non-stationary, yes, but we must evaluate all other 2 models. So also this table, yes, with your comment of result, yes, can be a part of your paper, yes. Of course, it's possible, yes, so you can use this, and we can continue, so please click on view, find unit root test, and we will select model with intercept. Okay, and you can see constant, the intercept, is not statistically significant at the 5% significance level. Yes, so we will not use the results from this model. Yes, yes, of course, according to this, it's non-stationary. According to p-value of coefficient rho, we can decide that rho is equal to 0. This is all right, non-stationary, but constant is not statistically significant. Wrong model. We will evaluate a third type of model, so please click on view, unit root test, and we will select the model with deterministic trend and the constant. Yes, okay. Finally, we'll pay attention to these last two rows, where is constant and trend, and neither constant nor trend is significant in our model, so we'll not use the results from this model. So the correct one is model without constant and without deterministic trend. And on the basis of this result, you can say that the time series of prices, of closed prices, is non-stationary. Yes, log returns, yes, were modeled. Yes, were modeled in stationary form, because we believe that the time series of log returns is stationary. Yes, and if we want to model the time series of prices, which is non-stationary, it's necessary for us to find the order of integration. The order of integration, the number of differences which must be done for the stationary of this time series. Yes. If you check the choreogram one more time, yes, please click on View, choreogram of level. So we evaluate now on the basis of Dickey-Fuller test. We evaluate this, yes, and if we check the differences, please click on View and the choreogram of differences, choreogram of first difference. Yes, there is a system. Probably autoregressive or moving average or Arma. Yes. Maybe Arma 1-1, but on different time series. The same, like in the case of log returns, yes, because log returns are logarithms of some ratio, yes, time series, which fluctuate around 0, yes. So we will evaluate unit root test, yes, on differences. Please return here, View, unit root test, and test for unit root in first difference, yes. And we will start with known, yes, with model with no constant and no deterministic trend. There you can see the results, and very, very important decision here, yes. There is a test statistic t-test for Dickey-Fuller, yes, and p-value is 0. So 0 hypothesis, non-stationarity is rejected at a 5% significance level, yes. It means that valid is alternative hypothesis, stationarity, and the time series is stationary in the case that coefficient of rho is negative. And you can see here minus 0.999 and p-value is 0. So this negative coefficient rho is really negative and significant. So again, one very important decision which can also be part of your paper, yes, because if I read this, I will know that you understand to these issues on the basis of augmented Dickey-Fuller test, the model without constant and without deterministic trend. At a 5% significance level, the 0 hypothesis about non-stationarity is rejected. So this time series, difference time series of closed prices, seems to be stationary. Yes, seems to be stationary. Okay, we will test. We will also evaluate the other models. So please click on View, unit root test, intercept. Yes, okay. I don't know. Yes, please click on OK. I don't know the results, but I expect that constant is not significant. Yes. Okay. Yes, constant is not significant at the 5% significance level. So this is wrong model. And one more time, you can click on View, unit root test, and you can select trend and intercept. Yes. Okay. And probably, yes. according to our expectation. You can see that constant and trend is not statistically significant, yes? Okay, so we know that there is integration of the first order, and this time series can be modeled in first differences, yes? First differences. So, I said that according to parallelogram of first differences, yes, we can try to start with Arma 1-1 model, yes, but on difference time series. So the name of this time series is close, yes, just close, and you can see here unit root test on D, like difference close, yes. So we will use this dependent variable in these differences in our equation. So please click on quick button, and we will quick button, estimate equation, and we will write here D parenthesis close, yes? So this will be difference time series, and we will write here AR1, MA1, yes? AR1, MA1, we will start with this. Again, at home, if you use the new version of eViews, yes? You must check that here the least squares, yes, not maximum likelihood. Please remember this, yes. If you submit me, calculated result of model, calculated on the basis of maximum likelihood method, my question to you and on your final evaluation will be, what is it, maximum likelihood method? Explain it. If you use it, you will have to explain it. Yes, this will be my question. So please use least squares, because you know what is it, least squares method, and you are able to explain the least squares, yes? But the maximum likelihood is a special method used for special analysis, different analysis, and for our purposes it's absolutely enough to use least squares, so please use least squares, yes? Remember this. Okay, so please click on OK, yes, and you will see the results very, very similar to the previous model, which was calculated on the case of log returns, yes. Moving averages are not significant at the 5% significance level, yes. So please click on estimate, delete moving averages, and again we will return to classical AR1 model, so Arma 1-0. On the case of difference time series, integration is of the first order, yes. So please click on OK. We will check the parallelogram, yes. Please click on view. We will check the parallelogram of residual time series. We have here Residual Diagnostics, parallelogram Q Statistics, OK. And okay, yes, you can see there is a significant column, so maybe again it will be good to add auto-regressive part of the second order, yes? So we will use information in time t-1 and also in time t-2, 2 lags, yes? So click on estimate, and please add here AR2. Yes, AR2, okay, and perfect. We have here 2 coefficients, phi, yes, and you can see that all coefficients, both 2 coefficients, are statistically significant, yes. Darwin-Watson statistic 2.041, yes, very close to 2, so probably there will be no autocorrelation. We will evaluate this in parallelogram, yes. So please click on view, residual diagnostics, and parallelogram Q statistics, yes, okay. Perfect, yes. Here, there is no correlation, yes, and you can see that there is no significant correlation structure. So dependence as is probably explained, but we can expect, maybe we can expect the problem in the case of volatility, in the case of heteroskedasticity. We can click on View button. There we have actual fitted residual and actual fitted residual graph. Yes, and you can see residual series. Residual series is constant in time until this point. Yes, there we have a significant change of volatility. So probably we can expect heteroskedasticity. Yes, we will try to give a proof. Yes, so we will click on View button. Please click on View button, Residual Diagnostics, and there is the heteroskedasticity tests button. We will use ARC test, okay, and we remember that zero hypothesis, homoskedasticity is rejected on all significant levels. Yes. And probably because there is a heteroskedasticity, significant change of volatility in time, there will be no normality in the data set of residual series. So please click on View button, Residual Diagnostics, and histogram normality test. Yes. Yes, it seems to be normal, but probably kurtosis is higher than necessary for the normal distribution. Okay, so we'll return on View estimation output. Okay. We will return where is our work file. I don't remember where is our work file. We can close this, we don't need this, that is our work file. Equation log returns, so we will name this equation close. Yes, because this can be closed. Close this, that is our model. Yes, so please click on name, and we will name this equation close. Yes, because we have here two Arma models. Yes. Two Arma models, but not sufficient models. Yes, because we have a heteroskedasticity in the residual series. Yes, and because there is a problem in the heteroskedasticity. Yes, it will be good to try another type of model. Okay, so auto-regressive conditional heteroskedasticity model. Yes, you remember that we perform this model only on logarithms. Yes, so everything is saved, so we can close this saved model. Also, this there is our work file. And where we have logarithms here. So there we have logarithms. We can open the chart, view, graph. Okay, perfect. So this is the development of probably. Yes, stationary time series of logarithms. You know that ARC model is model where we are modeling the squared values of dependent variable. We will try to establish this model, yes, of these logarithms. So we will click on quick button, yes, and estimate equation. Okay, so we know the dependent variable logarithms must be in squares. Yes, so log returns yes, power function, the head squared. Yes, so squared values of logarithms is dependent variable is followed by independent variables. We will try to add constant, but I think that constant will not be statistically significant, C, okay? And we will write here logarit, yes, logarit, and now it's necessary to use parentheses, yes, logarit, in parentheses -1, yes, in the first slot, squared, yes, so add squared. So this will be the first attempt, yes, of autoregressive conditional heteroscedasticity model of the first order. Yes, okay, so please click on OK, and wow, constant is statistically significant, yes, in this case. But probably, yes, this model will not be sufficient enough, because you can see Darwin-Watson's statistic 2.37, there is probably not enough explained variability and correlation, yes, correlation. Okay, so this is good start, good attempt. We will check view button, and we will click on residual diagnostic. We'll check correlogram Q statistics. Okay, yes. You can see in the case of second luck, yes, there is a significant column, so we must increase our model, more lucks, yes. So we will add more lucks, yes, autoregressive conditional heteroscedasticity model of the second order, etc. Yes. So please click on estimate, and we will add here logarithms squared in time t minus 2, yes? So logarithms in -2, and this must be in squares, yes? Okay, so please click on OK, and we'll check what is here. Constant now is not statistically significant, but statistically significant is other coefficients. So we will click on estimate, we will delete constant, and we will try to add one more coefficient, one more parameter, logarithm in time t minus 3 squared, yes? We will try it, yes? We are searching for good model. So please click on OK, and we can see that the third coefficient is not statistically significant, so this will be omitted. So we will click on OK, we will delete this last parameter from our model, okay? And we'll try to evaluate this, yes, significant coefficient, first one and second one, statistic Darwin-Watson 1.98, yes, is very close to 2, so probably there will be no autocorrelation, but we will evaluate this according to Box Q statistics. So please click on view button. We have here residual diagnostic correlogram Q statistics. Okay, we will check this. This is better. This is much better than before. Zero hypothesis. There is no autocorrelation. This zero hypothesis is not rejected. So probably there will be no problem with autocorrelation. The same result, the same decision as we had in the case of previous Arma models on close prices and logarithms. Yes, but there will be there was a problem in case of heteroscedasticity. So we will check arc test here if this model is better than Arma. So please click on view button, residual diagnostics, and we have here heteroscedasticity tests, and we will use ARC, yes, autoregressive conditional heteroscedasticity, Brouch-Godfrey ARC test, create on the basis of artificial regression of residues. Yes, so please click on OK. Zero hypothesis is homoskedasticity, and this hypothesis is not rejected. So there is a homoskedasticity in residual series. Yes. Can you see this model? Residuum in squares, yes, is explained by constant and squared residuum in the first block. Yes? So this is the simple arc model of the first order, but now put it on the residual series, yes, and on the basis of this model we can see that residues are homoskedastic. We can check the development of residues, yes. View actual fitted residual graph, yes. Okay, so this, according to our model and our tests, yes, this is at the 5% significance level homoskedastic. There we have fitted and actual values, yes. So this model is better than the previous two models, Arma on prices and log returns, because there is no problem with heteroskedasticity. Probably there will be problem with normality, so we can check view button and residual diagnostics. We have here histogram normality test, probably yes, log normal, yes. This distribution, we have log returns, yes. This is the distribution of residues from the time series of log returns. There is probably the problem with kurtosis. You can see that this value, this characteristic of kurtosis is very high kurtosis, and also with the long tail, yes, with the long tail on the top. Yes, so we have here some extreme value, and therefore this distribution is not normal, but log normal, probably log normal with the long tail on the top. Okay, so another model, the third model, so we can return back on view button estimation output. Yes. And in our work file we have equation 1, equation 2, and we will name, yes, we can close this, we can name this equation space and for example arc, yes, we'll name this equation space and arc, yes. So we have here three models. Okay, we can close this. And on the basis of these three models, we can try to calculate some forecast. Yes, forecast on some reasonable period. What is necessary for us if we want to calculate some forecast? We need to increase the number of observation. Yes, so you can see we have here 253 observation. Yes, we can. Yes, it's double click on 253 observation. It's necessary to use some structure. So please select dated regular frequency. Yes, dated regular frequency. It's possible, yes, to use integer date. Start will be 1 and will be last. Yes, please click on OK. Yes, it's sufficient now. And now double click on 253 observation, and we will add here as some number of observation. I don't know how many, 20. Yes, so we will write here 273, 20 observation. You remember from our seminars that there is not enough memory in these models. Yes, so probably we will be able to predict 1, 2, 3, 4, values to the future, and after we can expect that the forecast, yes, will be a conditional mean, a conditional average. Yes? So we will prepare the space for calculation of the forecast. Yes, resize involves inserting 20 observation, continue, and we have here the models where we don't have any predetermined variable. Yes, it's necessary to check your basic file as a sample file where you have downloaded the data. Yes, and check the structure of this data set. Yes. You can see that I have here now set the structure of my sample, yes, which is taken from my Excel data sheet. Please double click on this observation, and I set, yes, I already set that I have dated regular frequency, yes, dated regular frequency. I set the frequency daily, 5 days week. Please open this form. Daily, 5 days week, yes. And I set the first, what I did was that I set here the start date. The 3rd of February of year 2020, yes. This was my start point. 3rd of February 2020, yes. I downloaded this time series, yes. And end date, originally, that is written at sign last, yes. Do you remember from the beginning of our today's seminar, we had 253 observations, yes, 253. And now you can see here that there is written 273. This is because after it's a complicated, yes, you must test this if it's possible to write it. I wrote here the date 17 of February of year 2021, yes, and thus I increased our sample, our range on 273 observations. So we added 20 working days, yes, 20 working days. So we can close this. You can see that I have here 273 observations, so 20 observations without values. And if you open, for example, close prices, yes, the development of close prices, there is a space. There is a space for the potential projection, yes. Okay, so we can close this picture. Please close this picture and open the model. We will start with equation close. Yes, equation close prices. Our model Arma 20, yes, and we will try to forecast the time series of close prices on these 20 observations to the future, yes. So we will click on forecast, and we will use close prices, no differences, because this model is set on differences. Yes, forecast name will be close F like forecast, and that is very important. Yes, that is very important that we will try to calculate 3 forecasts with three standard errors. Yes. So there will be standard error 1, after standard error 2 in the case of second model, and after standard error 3 in case of third model. Yes. If you don't know where is the start day of your forecast, you need to open the empirical development of the time series here close, yes, and check where is the first not available value, yes, in this development, because the start date of the forecast is the first unknown value. In our situation, this will be 20 of January of year 2021, and the last observation for the forecasting will be 17 February of year 2021. Yeah, so I hope that everything here is all right now. We can click on OK, and we will see the forecast. Yes, and you can see that we have here some values, some predicted values as in this confidence intervals. As there is, for example, on observation 26 of January, 28,000. Please here 28,850, and here another observation, another predicted value, 28,853. Yeah, so there is a difference, a small difference, and we have here some prediction. After this prediction is constant, the conditional mean, the conditional average. Here you can see we have close F like close forecast. We have here standard error for the first models. Yes, we don't need this. Please close this. And we can continue with other forecasting. Yes, so for example, equation log returns. Yes, so we can open equation log returns. It's necessary to remember the start date, yes, for calculation of forecast. Again, yes, log returns. Please check log returns here. Yes, log returns. We can click on View, Spreadsheet, and we can scroll down. Yes, what I said, yes, in the previous situation. There is 20 of January 2021, the first not available value, so this must be set as like the start point of your forecast. We can close this. Where is our model? Here is our model. We can click on forecast. We will forecast log return F, like forecast standard error 2, because this is our second model. And there will be forecast sample. The start date is 20 January of year 2021, and the end is the end. Yes, so we can click on OK, and again, this is the development of the log returns. And according to our Arma 2.0 model, we are able to forecast 1, 2, 3, 4, 5, maybe 6 observations as of this development of log returns. We have calculated the confidence intervals. Yes? Okay, so there is another forecast, and finally we will try to use the last our model as this ARC model. So please open this model. And this is on independent variable log returns in squares, ARC model of the second order. Yes, and we can try to click on forecast. And please check this top part, yes, of this table. It's possible to forecast log returns or log returns in squares, yes? Because we have ARC model, we will use these log returns in squares, and after you know that it's possible to calculate, for example, the square root yes, and to reach the original values, yes, because we have here the original data set, yes. So we will forecast log returns in squares. Forecast name will be logrit 2, like in squares, yes, at forecast. Standard error with number 3, yes, standard error 3, and forecast sample will be the same, yes, will be the same like in the previous cases. So 20 of January of year 2021 and 17 February of year 2021 is the end. So we will click on OK. And we will see what is written here. Okay, so again, like in the case of previous situations, as 1, 2, 3, maybe 4 observations predicted. As you can see, the small changes, and after the development is constant. Yes. So we have here three forecasts. You remember that we tried to add our forecast to empirical values of our time series, yes, and we try to construct a chart, yes, with the development of empirical and predicted values. Yes, it's possible to put everything this to your paper. Yes, so it's possible to put to your paper these charts, these forecasts. As you can see, it's possible to use right button copy and put it to your document. As you can paste it here. Yes, and if you change the size, yes, you can put all 3 charts to this document and comment the result. Yes, and of course, it's possible to add empirical values here. Yes, do you remember why we did this? Please minimize or close these outputs. Yes, and okay. So for example, this one. Yes, what is it? Close prices. Yes, so here in the case of command block, yes, we can write series lower, yes, series space lower equals sign, and there will be forecast. Where is forecast? Close F, yes, close F minus 1.96, the quantile or the standard point, no comma, point, it's English speaking software, 1.96 times standard error 1, yes, standard error 1, because this was our first model. Enter, must click enter, okay, so there we have lower bound and the same series upper, yes, series upper, close forecast plus 1.96 times standard error 1, enter, yes, and now we will select close F, close, lower and upper, yes. Okay, right button, we can click on OK, open as group, we can click on view, graph and OK, view, graph and OK, and you will see this chart, yes. You know that we are able to freeze this chart, so please freeze this chart. Off graph is frozen and does not update, okay. This frozen chart will be modified, this can be closed, yes, please close this one, we don't need this chart anymore, yes, and this can be modified, yes, so we can double click to this chart, we can move this here on this position, okay, and there is an empirical time series, there is a forecast, this green line will be modified to black line. So select this one, black, okay. This one is already black. So, okay, and we are able to modify the legend, yes? So, double click on this. We have here close prices forecast, so you can write here close prices forecast, yes, close prices forecast. Here we can write close prices empirical data, close prices empirical data. And instead of over, we can write plus slash minus 95%, yes, 95% confidence interval, yes, confidence interval, and upper will be deleted, yes, upper will be deleted. Okay, we can apply. Okay, and there is one potential chart. We can click on line slash shade, and okay, we can select line pattern. For example, dashed line, some dashed line, yes, with width 1 point, for example, and observation. So return back line shade, okay, observation. Where is the start of our forecast? 20 of January 2021, but we must select the dash line and 1 point. Okay, so now we can click on OK, and yes, there is the start of our forecast, yes? Yes, this is wrong, delete, yes? Delete, okay, perfect. So this is one potential chart, and you can create other two these potential charts, etc., 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 yes? So the length of the paper from 10 to 20 pages, of the nice paper full of your text, statistical diagnosis, charts, table, description, etc. Yes, it must look like a semestral thesis of the university student. Yes, so I hope that everything is clear. Probably the next seminar we will speak more about this and about other cases. So I hope that this is the end. This is the end of our seminar number 10. I hope that it's useful for you. Some recapitulation what we did and what I expect from you. So there are my expectations, and I hope that you will create very nice work. So that's all. I hope that everything is clear. Have a nice day, and bye bye.